Equities mixed again this week as geopolitical worries take center stage and as earnings season kicks off. Weekly market update, October 14, 2023. Wall Street and the world started the week with Israel declaring war on Hamas after a surprise attack launched by Hamas on Saturday and worries that it might develop into a wider global conflict weighed on traders all week. Equity markets still turned in a mixed week as smaller caps underperformed larger caps, mega caps outperformed large and mid caps and value growth stocks. When Friday's final market bell rang out, the mega cap DJIA plus 0.8%, 500 plus 0.4% were positive, while the tech-laden NASDAQ in economic news, both the producer price index and consumer price index came in higher than expected and hoped, giving rise to worries of more rate hikes from the Fed of the 11 S&P 500. Sectors, 8 advanced with energy, plus 4.5%, being way out in front and consumer up the rear. Oil jumped 6%. The stocks and equities mixed as earnings season gets underway. U.S. equity indices turned in a mixed week as conflict in Israel garnered most of Wall Street's collective worries. Without question, the major news of the week was clearly the widening war in the Middle East, and not unexpectedly, defense stocks and energy stocks jumped while airline stocks declined. It was also the beginning of earnings season, and the big banks, Citigroup, Wells Fargo and JP Morgan Chase, all beat expectations. Accordingly, the large cap formed the large cap growth names on the week. Outside of that conflict, inflation was on everyone's mind, especially with respect to the release of the minutes from the most recent Federal Reserve meeting, but the Fed's meeting minutes were measured, neither dovish or hawkish. The release of the minutes from the Federal Reserve's September policy meeting didn't really forecast future rate direction, although the language that read all agreed that rates should stay for some time, and the Fed should shift communications from how high to raise rates to how long to hold rates, gave hope that maybe the Fed will hold rates at its next meeting. There was a lot of economic data for Wall Street to digest this week, including that the producer price index for September was up 0.5% month-over-month following a 0 August. The producer price index, excluding food and energy, rose 0.2% increase in August. On a year-over-year basis, PPI was up 2% versus 1.6%. Core PPI was up 2.7% versus 2% in August. The 2% year-over-year index for final demand was the largest 12-month increase since the 12 months ended in April. Initial jobless claims for the week ending October 7th were unchanged at 209,000. Claims for the week ending September 30th increased by 30,000 to 1,702. For initial claims decreased by 3,000 to 206,250. Continuing claims increased by 4,750. to 1,600,000. Benefits in all programs for the week ending September 23rd was 1,609,943, a decrease of 2,205 from claims filed for benefits in all programs. The final reading of the University of Michigan Consumer Sentiment Index for September came in at 68.1. The final reading for August was 69.5. 1 year ago in September, the reading was. The current economic conditions index rose to 71.4 from the preliminary reading of 69. August's final reading of 75.7, the index of consumer expectations fell to 60. The preliminary reading of 66.3 but was up from August's final reading of 65.5. Expectations ticked up to 3.2%. Inflation rises in September. The U.S. Bureau of Labor Statistics reported that the Consumer Price Index for all urban consumers, CPIU, rose 0.4% in September on a seasonally adjusted basis. After increasing the last 12 months, the All Items Index increased 3.7% before. The index for shelter was the largest contributor to the monthly All Items increase, accounting for over half of the increase. An increase in the gasoline index was also a major contributor to the All Items monthly rise. While the major energy component indexes were mixed in September, the energy index rose 1.5% over the month. The food index increased 0.2% in September. As the previous 2 months, the index for food at home increased 0.1% over the month, while the index for food away from home rose 0.4%. The index for all items less food and energy rose 0.3% in September, the same increase as in August. Which increased in September include rent, owner's equivalent rent, lodging away from home, motor vehicle insurance, recreation, personal care, and new vehicles. The indexes for used trucks and for apparel were among those that decreased over the month. The All Items Index increased 3.7% for the 12 months ending September, the same increase as the months ending in August. The All Items Less Food and Energy Index rose 4.1% over the last 12 months. The Energy Index decreased 0.5% for the 12 months ending September, and the Food Index increased 3.7% over the last year. Small businesses again not feeling optimistic as inflation is number one. The National Federation of Independent Business released the following on October 10th. The NFIB Small Business Optimism Index decreased 0.5 point in September to 98. Reading marks the 21st consecutive month below the 49-year average of 98. 20 reported that inflation was their single most important problem in operating their business, unchanged from last month and tied with labor quality as the top concern. Key findings include small business owners expecting better business conditions over the next 6 months deteriorate points from August to a net negative 43% seasonally adjusted, however, 18% than last June's reading of net negative 61% and definitely at recession levels, 40% adjusted, of owners reported job openings that were hard to fill, up 3 points from August and remaining historically high as owners can't hire enough workers due to few qualified applicants. Seasonally adjusted, a net 23% plan to raise compensation in the next 3 points from August. The net percent of owners raising average selling prices increased 2 points to a net 29% seasonally adjusted, still a very inflationary level. The net percent of owners who expect real sales to be higher increased 1 point from August to a net negative 13% seasonally adjusted, still a very open jobs still an issue. As reported in NFIB's monthly jobs report, 43% seasonally adjusted of all reported job openings they could not fill in the current period, up 3 points from August. Owners' plans to fill open positions remain elevated, with a seasonally adjusted net 18% planning to create new jobs in the next 3 months. 57% of owners reported capital outlays in the last 6 months. Of those making expenditures, 41% reported spending on new equipment, 22% acquired expanded facilities, 12% of owners spent money on new fixtures and furniture, and 7% acquired new buildings or land for expansion. 24% of owners plan capital outlays in the next few months. Fed meeting minutes released. Wall Street agonized over the release of minutes from the U.S. Federal Reserve's last meeting in December. Fed officials mentioned uncertainties around the economy, oil prices, and markets as supporting the case for proceeding carefully. Recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have slowed in recent months but remain strong, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter credit conditions and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risk. Further, the Fed said, in discussing the policy outlook, participants continued to judge that it was critical that the stance of monetary policy be kept sufficiently restrictive to return inflation to the committee's 2% objective over time. A majority of participants judged that one more in the target federal funds rate at a future meeting would likely be appropriate, while some judged it likely that no further increases would be warranted. All participants agreed that the committee was in a position to proceed carefully and that policy decisions at every meeting. The market predicting no rate hike in November. That the Fed will change the federal target rate at its upcoming November FOMC meetings, according to interest rate traders, is low, as over 92% believe the Fed will keep rates the same.